Hi friends, welcome to the SBI Securities Weekly Market Podcast with me Sudeep Shah. Hope you are having a fantastic weekend. First of all, let me begin by wishing you all a very happy Navratri and may God bless us and our families with the best of health and happiness. Now, today we would be discussing about what to expect in Nifty and Bank Nifty from here on for the next week, along with the key levels for both the indices. And we will also be reviewing the global market setup and also be discussing on key sectors that could make a move from here on and sectors that we should be avoiding in the next week. Now, in the week gone by, we have seen that Nifty could not cross 19,830, 19,850 levels and it witnessed a correction of over 300 points to end the week closer to 19,550 zone. Now, Bank Nifty too has ended the week on a negative note to the tune of 1.3% and it has closed at a 17-week low on a closing basis. So while Nifty is yet to breach its October month swing low placed at 19,330, Bank Nifty has created a fresh bottom for the month and has formed a lower top lower bottom pattern displaying underperformance as compared to Nifty. Nifty Midcap 2 has followed the benchmark index and has lost 1.5% for the week, but it was Nifty Small Cap Index that managed a flat closing for the week and thereby outperformed all the other indices. Now, coming to global markets, friends, we have seen global markets under intense selling pressure, and this is on account of two reasons. Now, firstly, there is this rise in US Treasury bond yields, which is now inched closer to 4.95%, and this level was last seen in 2007. And this is after Fed chairperson Jerome Powell stating that another interest rate hike could be coming and the Fed might not cut interest rates until late next year. And rising bond yields is always negative from the equity market perspective. So now looking at even the US equity markets, specifically S&P 500, this index is now trading below its 200 DMA and almost 65% of the stocks within the S&P 500 are trading below that 200 DMAs respectively. Looking at the chart formation, S&P 500 is now forming a lower top lower bottom formation and is displaying weakness with key resistance zone now placed at 4350 4370 zone, and it has yesterday already closed below its key support zone of 4240 where there was a trend line support, and till the time S&P 500 sustains below this level of 4240 4260, this negative trend could continue up to 4150 4120 levels on the down. Now secondly, the ongoing geopolitical situation in the Middle East has triggered a spike in crude oil prices beyond $93 a barrel and is potentially negative for the oil import dependent economies like India. So this crisis has also compelled investors to reevaluate their strategies and shift their focus from riskier assets to safer investments such as gold. And we've seen in the last week gold has edged closer to $2,000 an ounce. Hence, I feel that it's extremely critical to track these data points, whether it is Brent crude oil prices, whether it is dollar index and US 10-year treasury bond yields. All of them would have an important impact in the global equity markets in the coming week. Now, coming to the index levels, specifically Nifty levels for the next week, I feel that the crucial resistance for the coming week would be around 19,650, 19,680 zone where the 20-day exponential moving average is placed, and only a move beyond this level could trigger a small short covering up to 19,830, 19,850 levels. Now, while our near-term bias is negative, we feel that 19,300, 19,350 zone could act as a crucial support for the index in the expiry week, as it's a confluence of the 100-day exponential moving average and the prior swing low of the 4th October 2023, which was placed around 19,330 zone. So any sustainable move below this level of 19,300 would trigger a sharp correction into the index up to the level of 19,000 in the short term. So once again, from medium term perspective, I would like to reiterate that 19,830, 19,850 zone is an extremely important resistance zone, and only if this level is crossed, index can move higher up to 20,100, 20,200 levels. And remember friends, in the last several morning podcasts, we have already reiterated this fact that 19,830, 19,850 levels now assume significant importance. Uh, Going into the expiry week, if we see the option chain, significant put writing is visible in 19,400 and 19,500 strike prices, as well as on the calls front, 19,600 and 19,700 calls have witnessed maximum additions. So we feel that basis this data, the overall range for the coming week would be 19,300 on the downside and 19,700 on the upside, and the indices could trade with a negative bias. Now, looking at the market breadth from a short-term perspective, amongst the constituents of Nifty index, currently 50% stocks are trading above their 20-day exponential moving average, Now, last week, almost 64% stocks were trading above their 20-day exponential moving average. So, this clearly indicates that the internal strength of the markets have weakened as compared to the previous week. Now, coming to Bank Nifty, with yesterday's close, we have seen Bank Nifty index closing at its lowest level on closing basis since 15 June 2023. And we've seen in the last 1 month, indices have not been able to sustain above its 20-day exponential moving average, and all rises have been met with selling pressure at higher levels. And specifically, post this breach of 43,900, 44,000 in the past few sessions, we've seen any rise to that zone of 44,000 was met with severe selling pressure from higher levels. So this indicates that the banking index is firmly now in the grip of bears, and we feel that overall resistance now going forward positionally would be 44,200, 44,300 on the upside, where this 20-day EMA is placed. And only if this level is crossed, we can expect upside up to 44,700, 44,800 on the upside. Now, the key support zone for the Bank Nifty would be at 43,500, 43,550. Now, this zone is significant because in the last 3 months, we have seen several times indices bouncing back from this zone. But looking at the current structure, we feel that this support zone could get violated, and we could see a retest of 43,100, 43,150 on the downside, where the 200 DMA is placed. And also, in case this 43,100 zone is breached, we see this level being taken out, then lower levels around 42,800, 42,500 cannot be ruled out. So all in all, like 19,850 is a major level for Nifty. 44,300 is that major level for Bank Nifty that needs to be crossed on the upside. Friends, an appropriate approach to such markets which are surrounded by too many data points, and that too globally, which are beyond anyone's control, would be to mark important resistances on chart, and only if these levels are crossed, one could think of going long in terms of indices or any stock specific opportunities. And even the stocks that we choose, we need to ensure that they are outperforming their own sectorial indices as well as Nifty and Bank Nifty. And one more key thing that we should not be missing out is that we should not be doing any random bottom fishing, assuming any level to be a bottom or thinking कि ये और कितना गिरेगा, how much more it can fall. And along with that, one should also control leverage positions and remain hedged wherever possible. So now let us see which sectors are looking positive amidst this ongoing negative momentum, as well as which sectors one should be avoiding from a short-term perspective. So while we are looking at the charts, we are looking at the data, we feel that the real estate stocks, auto, as well as the CPSE sectors are looking positive, as these indices are strongly placed above their 20-day exponential moving average on the daily chart. And even looking at the derivatives data, a lot of stocks within these sectors have seen long built up in the last week, where the markets were completely weak. We feel that the traders should be avoiding bottom fishing in oil and gas, IT, metals, Nifty financial services, as well as the consumer durable space, as these sectors are now firmly placed below their 20-day exponential moving average on daily chart and could potentially slip further from here on also. Looking at few top stocks such as Reliance, HDFC Bank, ICICI Bank, HUL and ITC, all of these stocks are trading with a bearish bias below their key support levels, and this could put pressure on Nifty at higher levels. So one should not do bottom fishing right now in these names and let important resistances get crossed within these stocks, and then you should start planning your long positions accordingly. Now, looking at the FII data, if we see the FII's long short ratio for index futures, it has dipped to 25% once again, and they have added 6,600 short index futures positions yesterday. And this ratio, friends, for the entire month till now from the last expiry has been in this zone of 25 to 29%. And despite intermediate bounces in Nifty in the last 15-20 days, this ratio had never seen any significant improvement, and that is what is worrying me. Now, coming on the stock futures side, FIIs have sold closer to 9,200 contracts. On the options front, FIIs have bought approximately 17,000 contracts of call options, but they've also bought 74,000 contracts of index put options. So looking at this overall data, I feel it is weaker in nature and is hinting that the traders should be cautious with their over leveraged long positions and need to apply appropriate stop losses. Now, just to summarize, key support level for the Nifty for the coming week would be around 19,300, 19,350 zone, and the resistance would be between 19,650 and 19,680 on the upside. For the Bank Nifty, the key support zone would be 43,500, 43,550 zone, and in case this is breached, we can expect a retest of the 200 DMA placed around 43,150 zone. Resistance, however, on the upper side would be around 44,200, 44,300 levels, where the 20-day exponential moving average is placed. So friends, that's all from our side this week. Wishing you all an excellent weekend ahead, and we hope you enjoyed listening to our podcast and are finding it useful for your trading decisions. Kindly do subscribe to the channel for such updates and interesting insights, and do share it with your friends and relatives. So until we meet next week again, happy trading, stay safe, and thank you all once again.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.